Welcome to all of you, clients, friends. It's nice to have an opportunity to speak with you during this, what is crazy volatile time. And I can only imagine, what that feels like. When you're in retirement, you're relying on your nest egg, and that nest egg is what keeps you doing the things that you enjoy doing. And we take a great deal of pride and responsibility, and we're very thankful for the trust you've placed in us. And we also know, it's never fun to open an account, look at your account, see it's down. But that's really part of the investing world that is something that when we build portfolios, we know there's going to be bear markets. It's a fact that 3 out of 10 years is a bear market, and yet sometimes it feels a little different, right? Like here we are, it's very polarizing time in our country, and whether you're on one side of the aisle or another, I mean, there's a lot, as Brittany said, of noise out there, and the market volatility. I guess we titled our presentation well. 2,900 point up day yesterday, and now I think we're down 1,500 a day. So let's start with the media. First of all, I don't think the media are our friend in events like this. Largely because the media is very good at getting your eyeballs, and to get your eyeballs, whether it's the newspaper, website, podcast, doesn't matter, TV, they love scary headlines. I often use the analogy of the saber-toothed tiger, right? If the saber-toothed tiger's in town, that makes the headlines. The fruit tree that's in full bloom with fruit doesn't make the headline. And I mean, I think most days there must be 6 or 8 or 10 articles on our president, Trump. And by saying this is unprecedented, this is a problem, it makes us all very, very nervous. And the media loves frightening people because that's how they get paid, is to get your eyeballs. And I'm here to help you manage your money through what should be a very comfortable retirement. And the first thing I'm going to say is that we look at obviously the returns, but we also look at your financial plan. And your financial plan is your key to success. And most people have a plan. And if you have a plan, it's based upon your spending, your resources, and we know what the probability of success. And these sorts of events are just a tiny blip in the plan. And we don't just build rosy plans. We actually stress test them against the worst times in history. We expect these bear markets, and when they happen, we weather the storm. And how do we do that? Well, first of all, investment management and politics do not correlate, thankfully, because if they did, it would probably be an impossible job to do. Studies will show that it doesn't matter really who's in charge. Everybody gets good economic times, bad economic times. The trigger for these things is always very difficult to predict, and markets tend to react suddenly by going down, and then they slowly come back up, and it's the down that causes a great deal of concern. So when we sort of manage money, we have a plan. We know that market timing doesn't work. When these events happen, it would feel really good to be in the bank and not losing any money. But the problem with being in the bank is that the return is so low that you can't counterbalance for inflation. So we use modern portfolio theory, which I think I've talked to all of you about multiple times, and that does work. Harry Markowitz won a Nobel Prize in economics in 1990 based on the graduate work he did at the University of Chicago in 1958. So it took a long time for people to realize that Harry was pretty brilliant. and we use modern portfolio management. And basically that says we have negatively correlated asset classes, right? When stocks go down, bonds go up, and then you can build negative correlation within the stock portfolio itself. And what that does, it takes the peaks and the valleys and it kind of smooths it out. So when you read NASDAQ is down by 20%, well, your portfolio isn't down nearly 20% because we own bonds, depending on the person's 30, 40%. And then we rebalance that, right? So in times that, that we have these bear markets, we also have a system to deal with how to cover your distributions. But before I get to that, I want you to think back. A lot of you have been with us for a long time. And think back to, the most recent event. That was inflation, high inflation. Interest rates went up. NASDAQ went down 30%. And we weathered that fine. Prior to that was COVID, which, was frankly very frightening. And that one kind of felt like it might have been different, right? Global pandemic, markets corrected a lot, and we didn't panic. We hung in there, and eventually the markets corrected, and we made it through that just fine. I often refer back to 2007 and 2008. That period of time was, to me, more frightening than all of those because it was truly a systematic failure. This one does not feel, it almost feels like it's a created problem that could be easily corrected. I'm not saying it will be, and I'm not saying that the markets can't go down further. But what I am saying is we're prepared for it. We expect markets to go down 3 out of 10 years. And emotionally, what I want to say to you is that, our plans are in really good shape. We don't feel that there's any need for anybody to have concern. What I often recommend people do at times like this is tune out of the media, go take your monthly distributions and enjoy your life, and be thankful and grateful for all that we have, family and friends, and warm, comfortable place to sleep and good food to eat. And I look around and, the grocery stores are full, and I think back to 2007 and even 2008, and it's like life does go on. You got to eat, you got to turn on the lights, and what we invest in are companies, and companies make money in good times and then they make money in bad times. So, your accounts in stocks are volatile because of trading, and that we cannot control. We are not traders. We are long-term investors in great companies that will make money in good times and bad. Amazon, as example, as of a couple of days ago, was down 15%. Costco was down year to date 5%. And I look at those companies and I say, is Costco going out of business? Probably not. Is Amazon? Who can compete with Amazon with their distribution system? And so when you see all this volatility, sometimes what you think is, well, the market's down 10%, 15%. And that means it's going to be down 30%, 40%, 50%. Look, the market can go down by that, but does that fundamentally, is that priced right, or is that just emotions and traders? And I would suggest to you that a lot of it is trading, and it's very irrational. It doesn't make sense fundamentally. If your house was priced every single day and it was that volatile, you just say, well, this is ridiculous. My house is worth basically what it is today as it will be tomorrow. And I think the stock portfolios, that's true. They do, over long-term periods of time, just based upon earnings. But it shouldn't be like this volatile. So in a nutshell, we don't manage money based upon emotions. We have a system for managing money. It's battle tested, tried and true. Is that mean it's 100% guarantee? Of course not. But we've been through a lot of these. I've been in this business for 40 years, wealth analytics for 26 years, and so far based upon the research and the people we follow, it's worked out pretty well. And I think this one will too. So I don't really think this is different. Some of you might, but I'd encourage you, don't, try not to let, beholden to your emotions. As I said, I encourage people to, turn the TV off or what have you as it relates to that. And I think if you open up your accounts a year or two from now, they'll be just fine. Average bear market from peak to trough to full recovery is about 2 years, a little less than 2 years. And remember, for those of you who are taking distributions, we keep 2 years worth of distributions in cash. So this little short-term market volatility, what we don't want to do is get a position to sell stocks in a down market when they're not properly valued. So we have that 2-year cushion in cash. And then, if it's a longer bear market, we ladder out your distribution year 3, year 4, year 5, so forth and so on, so that we don't have to sell stocks in a down market. If we think a stock is going to go out of business, we'll sell the stock. But for the most part, we just want to weather this storm. We'll use the bond and cash resources, and eventually the stocks will go up, and then we'll sell the stocks, rebalance, and replenish the bonds. And I know that for some of you that sounds like a broken record, but what I want you to do is try not to be overly concerned, and realize that this volatility is necessary in a portfolio, because if you're all in cash, you have a level income stream, and what you really need is a rising income stream. And to do that, we have to own equity, stocks, real estate, etc., and that can be volatile. But it's necessary volatility. And when we use modern portfolio theory, we try to lower the volatility down by using the negatively correlated asset classes to dampen the volatility, so that your portfolio is usually down 50% of what the market is, and then we try to get 80% of the upside. So it is really quite efficient. So in a nutshell, I'm going to kind of wrap up this part by saying, we are confident in our ability to help you. We're also very confident in our financial plans, and you don't run out of money all at once. It takes years and years of poor returns. And when we do your annual review, we're going to look at your plan every year. And if we think that there's concern, we will certainly raise the red flag and let you know that. And for most of you, you also know that we have sort of 3 categories. You have your needs, your wants, and your wishes. And if we have to make an adjustment, we're not making any adjustment in the needs. And oftentimes not in the wants. We might adjust a little bit in the wishes. And that's usually temporary until markets recover. We're nowhere near that right now. It's very polarizing, I know. And I hope that we can get some clarity and market volatility goes down. But for now, I think we're in pretty good shape. So with that, I'll turn it back to Brittany, and we can talk about questions.
Awesome. Well, thank you, Troy, for sharing your perspective, wisdom with us. And I'll go ahead and I'll be monitoring the Q&A. We're getting some questions in, and we also have some questions that were submitted ahead of time. So let's go ahead and get started with those. All right, first question. Let's go with, this is kind of general. What do you think in general will happen to Medicare and Social Security? There's, been a lot of talk about both of those topics lately.
Yeah, well, I think all of us know that Social Security is in a surplus, but that surplus is ending. And, unfortunately, there was years and years and years of surplus, and that money was not sort of put away to the side for when there wasn't a surplus. So you've got a situation where the system needs some fixing. I don't frankly think that's difficult to fix. I think what you need to do is have people work longer and pay in longer. When Social Security first came out, in the 30s, you got Social Security at 65, male life expectancy was 62. Now, obviously, if you're retiring at 65 and live to 85, it's a whole different set of numbers. Not great news for the younger folks. I get my full Social Security at 67, so they've made that switch once before, and they'll probably do that again. I think Medicare is a bigger challenge, but I would suggest that it would be suicide for any politician to attack Medicare or Social Security. They just won't get reelected. And frankly, that's their job, is to get reelected. So I don't see that changing.
Great. Next question, where, do you feel like inflation is heading? And most importantly, as a client, how are they going to be able to deal with inflation?
Yeah, that's a good question. And it's probably, where is inflation going? It's one of those unknowable things. I mean, you ask three different economists, you'll probably get three different answers. I would think that with tariffs, if they actually get implemented, that clearly, goods from countries that are being applied to tariffs, things would be more expensive. But in recession, things like cost of fuel and things go down. And I would also suggest that, you could buy American goods versus foreign goods. That's another option. I think ultimately what we ask ourselves, or what you're probably asking, Britt, as it relates to the client is, how do we deal with inflation? Well, your financial plan is geared to have a rising income stream. So our plans look at inflation, and we don't keep a level income stream. And we're able to rise your income by investing in stocks, which theoretically go up over time. And that way you keep your same buying power, much like Social Security. So cost of goods and services go up, and then we take more money out of your portfolio and send it to you year by year, so that you have the same purchasing power. And I think we're in good position to continue to do that.
Excellent. Kind of went through this one, but this time feels different. Do you feel like it's different, or
Well, that's an
what
interesting
might be
question.
different?
Yes, because ultimately, through my 40 years, I've asked myself that many times, and I think back to Black Monday in 1987. I was fairly new in my career, and the stock market dropped 22% in one day, the single biggest drop in history. And it wasn't now the single biggest point drop, but percentage drop. And I walk around today and I see the sunshine, and I see people walking around. I see food in the stores, and I don't really see like there's sort of Armageddon out there. I mean, it's a lot of it is sort of manufactured Armageddon, I guess. So in looking at periods of time, I don't think this one is different. It could be different, and yet we don't. We'll continue to monitor that, and I mean, we can go to cash if we need to, but I don't think we need to. And I really think that this is just a standard sort of correction bear market. We're not quite yet to bear market stage. I mean, frankly, 2007, 2008 scared me a lot more than this does. Because we had some fundamental problems in the global financial situation, largely based upon real estate loans that people couldn't afford to pay, and they were given loans based upon false data, and that was bringing all the banks down. And at that stage, I thought it could have been different. The government did step in, and it was a bigger balance sheet. And whether you agree with it or not, I thought it was the right thing to do at the time, and we held in there. We actually started buying stocks in 19. Well, I shouldn't say 19. It was 2008. In November, and of course stocks went down from there, but they eventually came back up. And we were buying consumer staple stocks because, like I said, people got to eat, got to turn on the lights, got to turn on the water, and we realized that those companies were actually doing quite well. So no, I don't think it's different this time. I think every one of these feels like it's different. I mean, COVID felt different, but generally, I think we'll weather this storm just fine.
Excellent. We have a good question here. What are your thoughts about diversifying across geographic and international stocks versus the US stock market during this time? For example, could non-US markets anticipate a rise while US markets are down?
Yeah, that's I wish I knew the answer, right? Because we just go where we're making money. I frankly think that the international markets are at greater risk, although we're not changing our allocation. We still have international stocks. We can underweight slightly. We don't get generally go in and out because that's a market timing thing. Um, but we have a big deficit in trade, and so I mean, if you have a surplus in trade and you're getting tariff and people aren't buying your goods, I think maybe that might be more concerning than buying domestically. But regardless of that, I mean, that's what negative correlation is about. You're going to own all of those asset classes. Some of them are going to do well, some are going to do poorly. And at the end of the year, or, if they get out of tolerance, then we rebalance and we sell the stuff that went up and put it in the stuff that went down, counterintuitive, but actually very effective.
And what are your thoughts about cryptocurrency?
Well, I did a webinar, I guess, about a year ago on cryptocurrency, and I still believe that it's a good place to put money because of government's very large deficits. And fiat currency, I think over time will devalue. And theoretically, I mean, the only one I talk about is Bitcoin. I think that has potential over time. But having said that, it's not like putting your money in the bank. Obviously, it's a very volatile asset class, and we've seen it go down quite a lot. Um, but I think over time, it's a very good place to store money. I wouldn't put huge percentages of your portfolio in that, but 1 or 2% allocation over time, I think might serve people quite well.
All right, we have a question here about the advances in healthcare are extending life expectancies. Will people or clients run out of funds with living longer? How are we covered if we live 10 plus years or longer?
Well, that's why we have a financial plan, right? So every year we should be doing an annual review. If you're not doing it every year, it's probably okay. But at least every 5 years, we should be checking in on how is our plan performing versus our assumptions. And and life expectancy is going up, and it's not just generally, but also within our client base. Because our client base are highly educated, they've got access to great healthcare, and consequently, they're living much longer. What we're seeing in practice is that people are spending a lot less money on leisure late in life because it's difficult to travel and do things like that. But often the healthcare expenses can be higher. Most of that should be covered if you have good Medicare coverage and a supplement and so forth. The long-term care issue is always a concern and very, very expensive. So that's why we check in and look at these things and see how we're doing. So mid-course adjustments are important. And if your plan says you live till 90, we can run it out to 95 or 100 and, say, well, how are we doing there? It's always a balance. It's like a teeter-totter. I think of it that way, in that, you could spend no money and then you're ensured that you're going to have a lot of money at the end, but that doesn't lead to a very good life, right? So, spending money in retirement is important so you lead a great life. And that's why we saved all those years. And that's why we do a financial plan so that we have some guideline to say, hey, is it okay to take out a little bit more? Or, in times where you get 2 or 3 year bear markets, then maybe the appropriate thing is to cut back on some of the wishes. Maybe you do domestic travel instead of international travel. And we're here to advise you on all of that and to raise red flags. It's never fun to raise a red flag. Unfortunately, we haven't had to do that too much. Maybe 2007 and 8 comes to mind as when we start raising some red flags. But certainly we can address your longevity question by making changes in the financial plan.
Another question here. Is there a stopgap in place to prevent my account from going to zero?
Well, there are no guarantees in the stock market. And one of the ways that an account goes to zero is if a company fails, right? So if you buy one company and it fails, you go to zero. Well, we don't do that. We buy hundreds, thousands of companies, very well diversified. And I always try to compare that for people because, some people come in and say, well, I got this great company and, it's doing great and it's higher return than your diversified portfolio. And what I try to share is that, but the level of risk is so much higher, right? What's the risk one company fails versus 1,000, all 1,000 companies fail? So, for account to go to zero, that's, almost impossible in stocks if you're well diversified. And remember, Costco probably going to be in business for a long time, and so is Amazon. So if we buy those great companies, they're going to do well. They make money in good times and bad. Further, we're buying primarily United States Treasuries in the bond area, and that's the safest asset class in the world. So if the government gets so bad, they just print more money instead of defaulting, which means there'll be more inflation. There's risks in whatever you do. You put your money in the bank and you say, okay, well, I'm safe. But what happens if the bank fails? Well, then you've got the FDIC, which is insuring, depending on the bank, 250 or what have you. But the FDIC doesn't really have the money if all the banks fail, right? They only insure 2% of the deposit. So it might not be a comforting answer, but the reality is that if you invest wisely over time, you're going to make money, and we're confident we're going to make money, and your account will not go to zero. We've never had an account go to zero. So there you go.
Great. Just some questions here about timing of distributions. Is this the right time to lower their monthly distribution or push their RMD to take that later in the year, or is that not something you would consider?
Well, the thing we're saying right now is financial plans are in great shape. And, if it becomes a longer, protracted 2-3 year bear market, we're prepared to deal with that. We're prepared to send you your monthly distributions by using our cash reserve and bonds. So no, I wouldn't say don't change a thing. Just go take your monthly distribution and go enjoy yourself. That's what I say. If when we do, rerun your plan, if there's issues, we'll raise a red flag. But no, it's not time to do that. I mean, some people might be in a position to say, well, we really don't need all this money. Can we just spend a little less? And, I'll give you permission to spend less, but it's not necessary at this stage.
Great. And how long will it be for this tariff downturn to recover into a boom bull market?
Well, if I knew that, boy, I'd know a lot. And I don't know. But what I do know, and I think I mentioned earlier, is the average bear market from peak to trough to full recovery is less than 2 years. And that's the average. So it could go longer. And we have, sort of bond reserves if it does go longer. So we're prepared for that. And could it be the worst in history? Well, it could be. And then, we back test and stress test against the worst times in history, but it's not to say that, that couldn't happen again. But again, you don't run out of money in a short period of time. It's a long period of time. And, so, we're confident that, in 7 years' time, these markets have recovered.
We have a great question here. What are your thoughts on holding gold?
Gold is always a great investment to hold during, times of turmoil. But of course, buying gold now, you're buying is a lot of money. It's gone way up, right, over the last couple of years. Certainly has a place in a portfolio and could be used like a cash or bond reserve where, if things get really rough, then you sell gold to meet expenses. But hopefully we don't get to that point, but I think it's a good investment. Certainly, it's like crypto in that it's a alternative. It's a negatively correlated asset class. You know, when the world goes to hell in a handbasket, gold does good, and we like that.
Do you feel this is a good time to deploy extra cash into the market?
I do actually. My son works for Amazon, and 2 days ago he sent me an email, and of course a lot of his comp is tied to Amazon stock, so he's very sensitive to Amazon stock price. He said, "This seems to be a good time to buy Amazon," and my answer was yes, buy more, right? Because over time Amazon will go up, in my opinion.
Excellent. Just a couple more here. What are your thoughts on the bond market right now? They noticed some people were selling bonds.
Well, the bond market is very complicated, right? There's lots of different types of bonds. There's high yield bonds, so there's corporate bonds, there's government bonds, there's mortgage bonds, there's treasury bonds. And for the most part, we don't play in a lot of those spaces. We do in some of the diversified bond portfolios, but largely our individual bonds that we buy are United States treasuries. And they are a safe haven in a storm, and they will do well. I like to point people back to 2007 and 2008. A 30-year treasury was up 30% in 2008. 30%. Now it didn't change, but everybody was selling stocks and buying bonds, and consequently it did the price up. So that's why we buy treasuries. We want a negatively, if you buy a high yield bond, that's a corporation that is, less on solid ground than a blue chip corporation, and those companies will fail in a recession, and then you lose your bond money. So it really depends. Mortgage bonds are more secure because they're backed by the house that was lent against. But the bankers, if all mortgages fail, they don't want the houses back because there's nobody to buy them. So that's why we like treasuries, and I think that treasuries are definitely going to go up the more difficult it gets. But they're also interest rate sensitive, and if interest rates go up, bond values go down, and that's just a fact. Usually, in rough economic times, you'll see the Fed lower interest rates to stimulate the economy, and we're not there yet. But if that were to happen, obviously, then the bond values are going up. So you can't really say people are selling bonds. You got to talk about what type of bonds you own and why.
And one more here. What is Trump doing and why?
Yeah, that's another question. I have no idea, and to either of those, which is not to say that he's not doing the right thing or the wrong thing. He's attempting to do the right thing, and whether it's right or wrong, that's sort of beyond my pay grade. I think when we look at the United States of America, I continue to believe that we're the dominant global power out there, and hopefully we don't get into wars. Hopefully this doesn't happen to that. But I think economically we're very, very strong, and trade deficits and all that. I don't really know. I don't think a lot of people do. It makes it difficult for all of us when there really doesn't seem to be a game plan. I mean, there was a game plan, and then it changed yesterday, and so they're, I think, trying to figure that out themselves on the run. So we'll just have to be observers and tune out the scathing headlines, and go down to the beach and take a walk and buy an ice cream and enjoy the day.
Absolutely. One more here. Do you feel like it's possible that tariffs could potentially cause both stocks and bonds to go down simultaneously?
Anything's possible. If interest rates rise, bond values will go down, and we have seen periods of time where they are correlated. Will that happen with tariffs? It's not expected. Generally, stocks and bonds are negatively correlated. So over longer periods of time, certainly they are. Shorter periods of time, they can be correlated. And if you see that correlation, I mean, we saw that in our most recent when interest rates were rising. We had high inflation, interest rates are rising, and they're trying to slow down the economy. And so at that point, both stocks and bonds were correlated. But interest rates are relatively high. And actually, for us, that's a great thing, right? Because if 40% of our portfolio are in bonds and we're earning 4.5% or more, that's great, because in the days of really low interest rates, we were getting treasury bonds under 2% for 10-year treasuries. And it was very low interest. People were not excited about buying a treasury bond. But of course, we don't buy them for the yield. We buy them because they're negatively correlated. But in this case, we're getting the negative correlation and also a very nice yield.
Absolutely. All right, I'll start to wrap it up here. If any last questions come in or you think of any last questions, feel free to put them in the question and answer and we'll go ahead and address those. But just wanted to thank you, Troy, for doing this webinar and especially all of our amazing clients who took their time to join us today. And we hope this was helpful. And we're also here for you if you want to talk on a more individual level via email or phone. We're here, so feel free to reach out to us. And any last questions, Troy, that you wanted or to share before we wrap it up?
Well, I just share that we take this job very seriously. We know it's your hard-earned money. You've worked all your life to have a comfortable retirement, and we're highly committed to making sure that happens. When we see you, we come in the office, we hug you because we care about you, and we care a lot about you. And if you're feeling uncomfortable and you want to talk personally, we're 100% here. Pick up the phone, call us, talk to us. That's what we're here for.
Awesome.